Hey, welcome all to Strong Valley's first roundtable of 2023, following a pretty tough 2022, but excited to start a new year and talk about some of the things that have happened since the last one of these we did in November. We typically start with a little market recap. I'll let Kyle kind of kick it off there, and we'll follow on after him.
Great. Thank you all for joining us again. It's been, like I said, I think it was about November when we did our last one. So it's been 3 months here. So kind of like to just kind of bring everybody up to speed on what happened kind of the last bit of the end of the year there and kind of kick off 2023. So as Adam hinted, it was a rough year last year, to say the least, both equity and fixed income. A lot of that was based on, Fed raising interest rates, the inflation talk. We had, conversations early on in the year that kind of transpired the rest of the year with the Russia-Ukraine. So a lot of things, even the midterm elections, it was just a busy year news cycle wise, but really in high inflation and the Fed raising rates. I believe it was 7 times last year for, about 4.25 percentage points throughout the year that really drove both the equity and the fixed income markets down. So I'll do a little bit of recap there for the end of the year. We finished the year down about 18% for the S&P, 33% for the tech-heavy NASDAQ, and even our fixed income having our worst year ever, down 13% measured by the U.S. Barclays Ag. And we talked about that a lot in our monthly market matters as well as some of our other roundtables. So I don't want to hone in on the total returns there and kind of a lot of the discussion that drove it. But we did finish the fourth quarter with a good little run upward. So we did have a positive fourth quarter, which was definitely welcomed. And we experienced that across the board, both equities and fixed income. So the S&P was up about 7.5% for the fourth quarter. NASDAQ was still flat to slightly negative for the quarter. And then our fixed income did claw back about almost 2% in the Barclays Ag. So that's kind of what wrapped up the year and finished off where we kind of left on our last call. And into this year, off to 2023, we started off with a pretty hot January and into most of February. So been nice to see some green on the screens here for the last bit. And a lot of that was driven by the talk from the Fed and the slowing in inflation. I know that we've talked a number of times on here that kind of one of the things we're looking for is inflation to peak and start to come down. And our readings over the last 4 or 5 months have definitely shown a reduction in inflation. Definitely not back to that 2% number that everybody's trying to target. And you're probably still feeling the high inflation at the grocery store, although gas prices have come down a little bit for us too. But so people looking at the inflation numbers coming down, potential slowing in the Fed and aggressiveness of the rate hikes. So we've already seen a 25 basis point hike as opposed to the 50 and 75 that we were getting accustomed to seeing. So I think that definitely helps as far as the optimism that maybe at some point in the second half of the year that inflation will kind of be back down to normal levels or lower levels, and the Fed may even slow down, if not start lowering rates. So I know that we'll talk about that a little bit here throughout as we dig more into the inflation and the interest rate side of things. But that's really what's kind of driven these markets up this year. And then recently we just had a print this week here regarding that there was a slight tick up in the month over month inflation number. So still trending downward overall for the year over year, but that month over month kind of had a slight tick up. And I think that caused a little bit of a pause in the run up in the markets. And we've had a little bit of a pullback here the last week or so. But overall, markets are still positive as of about the end of February. S&P is up about 3% for the year. NASDAQ has been on a straight upward movement here this quarter, this year, following a really bad year that we talked about last year, and that's up about 8.5%. And then our bonds are holding their own. They're up about 0.5% so far for the year of 2023. So that's kind of just a quick little recap of the last year, the fourth quarter, and kind of what we're seeing so far this year and the markets and a little bit of the news with the Fed inflation and interest rates. So,
and I think it was 7.7 inflation in the last roundtable. So down to 6.4 now. And I know one of the things that confuses people is there's so many different measures and they're constantly changing how they're measuring, inflation and CPI, and is it core or non-core, and now the way they've I think they've adjusted the way they're doing the rents, and so it is a difficult metric to follow, and that's why we get a little bit of bumping around as people you see inflation coming down, but then a number reads that they're not, isn't exactly maybe comparable to the previous number they used a year ago. But it's a constantly changing metric, and it's a guessing game. But it is subsiding as we see from definitely from the last roundtable.
And the numbers that JP Morgan puts out have been pretty close as I track them. They're within about 1/10 of a point in terms of what they forecast. So early summer, late spring here, they're looking at year over year. So the trailing 12-month inflation to be down around 4, and then as we get into the middle of summer, into the 3s. So that's going to be very different from, like you said, Adam, the 7s last time we came together.
Yeah, and I think the peak, if you put that up real quick, I think the peak was 9.
Yeah, 9.1, I think it was. Yeah.
Yep. And that was June of 22, and they're June of 23. They're forecasting 3.3. The people at JP Morgan are.
Yeah, and here's the year over year inflation all the way back to 1990. So you can kind of see, obviously, where we're at now is basically uncharted waters for the last 20, 30 years. But again, still trying to move our way down, and all the indications are that it inflation is subsiding.
Well, that ties back into one of the things we've talked about, I think, previously in one of our roundtables, and something we've been saying in client meetings. And I pull up a chart here, this kind of performance following the peaks inflation. And one of the things we always say that the market's a leading indicator, but some of the data that it looks at obviously is in the rearview mirror. So we'll never know for sure what the peak inflation number was until it's already passed, right? Until it's behind us. And so, I thought that 9.1 number that we saw back in June was pretty high. And most of the numbers since then have obviously been coming down. I think most everybody feels that was kind of what will be the peak of this period here. So historically speaking, when inflation kind of peaks going forward, we start to see a pretty good bounce in the markets from that sell-off that we've experienced here, as you can see by this chart. So obviously, you can't guarantee that's what's going to happen every time, but we do still look to history to kind of predict. And obviously, coming off of high inflation, when that kind of peaks, there becomes a little bit more optimism in the consumer side and getting back out and spending, and hopefully growing in the economy as well. So
it's amazing how dominant this conversation is. I mean, we're probably so all tired of talking about inflation, and it's been going on for 18 months. I feel it's been a topic. And I mean, if you had asked me, most of us have been doing this about 20 years or so. And if you had asked me, when do they even report inflation? 2 years ago, I wouldn't have had a clue. And now everybody watches it like the Super Bowl each month. And it's like the 13th of each month, everyone's on pins and needles, and the stock market goes up or goes down based upon this inflation. And so I know the clients are feeling the same way, and it's going to be the most important thing until it's not, and then once inflation is curbed, it's continuous trend down, and it gets anywhere near this range, we'll be off worrying about the next thing. But right now, it's definitely dominant. And I don't know if this kind of segues into what we're seeing with interest rates. If you guys want to move on to that at all, and kind of what the government is doing and why this is affecting.
Yeah, I think we've talked a little bit in the past too about, that yes, the interest rates or the inflation has caused the raising of the interest rates and having the impact it had on the fixed income side. But the other side of that coin is there has been some benefit to the raising of interest rates too on short-term cash and short-term investment options now actually being compensated to hold. So I don't know if that's what you're talking about, Jason, about transitioning there, but that's at least the one benefit we've talked about through this process over the last handful of months with clients.
Yeah, I think it's a good segue. I was going to mention that, the one thing that most people are not familiar with is really what the government can control and cannot control, and really what they're trying to do throughout this whole strategy of raising interest rates. And for those that have watched the financial markets over the last year or heard through on the news where the government is raising interest rates, I mean, really that is just affecting the short term, the overnight rate, what you're seeing like on checking accounts, savings accounts, we see on money markets, things like that. And that's all that they can't control. They can't control what mortgages do, long-term treasury bonds, credit card rates, car loans. They don't have a direct effect on that. That's just going to be supply and demand in the market, which does trickle down from them raising rates. But the whole reason why they are raising rates is really to curb spending. And so if money is
and to encourage saving, right?
Well, there you go too.
And to encourage savings.
Encourage saving. Good point. Thank you. And to curb spending, because if money is harder to borrow, I think last report, Chris, I think you have this. What are car loan rates right now?
So if you depends on who you talk to, but or what you look at, because I looked at one measure, I think it was on bankrate.com, that showed it was in the high 6s. But a couple people that we know that are in the car business, they're seeing most new car rates are in the mid 8s. So you're borrowing money at, let's say, 8.5 for a brand new car loan, and average used is somewhere in the 11, 12 range, which seems incredibly expensive.
Well, there
Now,
you
some
go.
people listen to this might go, "Hey, I remember when mortgages were 15%. So
But-
6.5 or 7 doesn't sound too bad,
but not in 30 years,
40.
Yeah.
Well, and
And
you
so-
remember recent years, if you're going out and buying a new car, I mean, you get loans for 0%, so.
So to answer clients' questions, that's what's happening, because if you've got a car that maybe isn't your favorite, but it's not broken, or you can go buy a brand new car, but now you're borrowing money at 8%, it's going to have fewer people fighting over brand new goods as opposed to when rates were at 0. So that's in essence what the government is trying to do. And then some of you may or may not heard of this term they keep overusing called a soft landing. And in essence, what Jerome Powell, the Federal Reserve, is attempting, or at least we think he's attempting, I don't think he's ever even used that word, is to raise rates just enough to curb the inflation, but not raise rates so much that it wrecks the economy, and just kind of tiptoe through the middle. Time will tell, and really kind of we land through this, but that's the process of what they're doing to kind of bring y'all up to speed on what's going on with rates. And so I think the forecast now, we've got a chart on what the market is forecasting rates to do. Guys, feel free to jump in, but in essence here, what's going on, current market forecasts based upon where inflation is. And really what drives a lot of this too is that, we watch two things. It's not just what he does with interest rates each month, but it's also what he says he might do, which they kind of try to,
future.
they kind of read the tea leaves.
Mm-hmm.
And so current forecasts believe that there's most likely 3 more small hikes left. That's going to take us into early summer. And then most people believe there's going to be a pause. And then the consensus right now is that at the end of this year and into next year, they're actually going to be cutting rates.
But this is how dynamic this is. So in January, there was a 3% chance based on what the market was anticipating of 75 basis points by June, which is what Jason's talking about, 325 basis point moves. And now it's a 71% chance. So again, it's a very fluid measure, and the Federal Reserve is fluid as well. I mean, they're looking at data all the time and deciding what they're going to do, and then the market's trying to adjust to that. So now we're at 75 basis points, probably at a 71% chance, and even a quarter, 24% chance of 50 basis points in March. So again, that'll change daily, but it just shows how you expect rates to top out at a certain level, and then as more and more data comes in, everything kind of adjusts accordingly.
Well, and that's what we talked about too, is, the Fed really only has that one tool in their quiver right now, right? It's the raising of rates, and inflation's a bigger monster that's been created over the last couple of years with, government spending, easy cash, easy money, supply chain issues, all that kind of stuff that led to the high inflation. And so it's them trying to balance the data that's coming in with the one tool they have. And one of the things that they have to keep watching too, as we talked about before, was the unemployment number and the job numbers, because, if that job market stays tight and there's more demand for less workers, well, then wages have to go up. And if wages go up, then consumer spending can go right back up and drive inflation. So there's a lot of moving parts that go into the measurements and the data there that makes it really hard to predict or project for sure. And like you said, it changes so quickly, as Adam mentioned. It's changed from 3% to 70. What did you say, 75% here on the last.
Well, and in 2 weeks, we're going to get another inflation report, which will change those probabilities again.
Yep.
I was going to mention one more thing. If I've got the ability, I'm going to try to pull that chart back up that we just had on the forecast rates. Because one thing I want to mention, kind of tie it back into investments. I know for many of us, a very large investment that a lot of our clients have on the books is going to be money market. A lot of clients like the peace of mind, and the interest rates have not paid anywhere near this in 15 plus years. And so I get it. But the one thing that I'd like clients to kind of be aware of is that if the chart you see right now on your screen, and if you're just listening, the forecast is that rates would go lower if the government cuts rates. If that were to happen, then there's a very strong likelihood that the rate on your money market fund would pay less over time as well. And so dependent upon your individual situation, but a conversation that we would have with you would be dependent upon that. If you are enjoying 4%, 4.5%, it might make sense for your situation to lock that in for a longer term, meaning like via a Treasury or something like that. I mean, everyone's situation is different, but if this trend holds, then this idea that you were going to get 4.5 to 5% in cash and money market and just kind of ride that off into the sunset, that may get it adjusted if rates move.
Yeah, for sure. And so Treasury is a sweet spot right now. Basically, you can get about 5.1% at 6, 9, and 12 months. So that's the high point of the yield curve. And just to show again how dynamic this is and how much has changed, Jason mentioned money market is a daily number that moves based on current rates. But in January 22, the average money market was paying 7 basis points. That's 0.07%. So that's what you were getting just a year ago. And now we're at 457 versus I think 388 was the last time we did the roundtable. I think we were at 388 on Schwab's money market, and we're at 457 now. But just from a year ago, 7 basis points, crazy.
And that shows both ways, right? So if we talked about how we've benefited from the raising of rates, and that's transpired into higher interest rates on our money market, our CDs, our treasuries, that at some point when that curve does flatten and start to come down, those rates will come down that you're receiving as well. So I think that's what Jason's hitting at, as far as that if there's money, or for clients that, depending on your situation, that have money on the sidelines that plan on leaving it for an extended period of time, if you're comfortable with that rate, it may make sense to make it a little bit more permanent versus the fluctuation of the money market. So
well, one more quick follow-up before moving on from that, because a very common answer is, well, I mean, if rates are going to go up a couple more times, then why don't I just wait for that and then do something? And then my response is, the fact that we're telling it to you right now on a podcast, we know it, everybody knows it, everybody is playing with the same information right now. And so the market has already moved to it. And so what would cause the market to move differently from what you saw on your chart would be for the government to react differently than what they have already said and what we already believe they're going to do. So if the government raises 1/4 point here next month, what you saw on your chart will probably move very little at all, because the cake is already baked. That price is already set in. So waiting in that sense is not really going to behoove you unless rates go up more. The other thought there is that, I've talked to clients who are like, okay, well, I'm going to stay in money market until rates start going down, then I'll lock it into a longer term bond at that point. The risk there, now granted, rates could always keep going up, but the risk there is that if we wait until that point, then the rates that treasuries are paying now for 6, 9, and 12 months aren't going to be 5 anymore. They could very well be 4.5 or 4 or 3.75 or whatever. And that's if we catch inflation. Obviously, it could go both ways, but I just kind of want to explain the relationship there.
Yeah, and just to touch a little bit on what you were talking about earlier, Jason, with what the Fed actually controls. The further you get away from 30 or 90-day rates, the closer you get to 5, 10, 30-year rates, the less control the Fed has over that. So they don't really, for the most part, they don't really play in the 10 or 30-year bond space. And so that just becomes a function of supply and demand. So like you mentioned, if people suddenly go, oh, well, my money market rate is starting to decline, let's go ahead and lock in 1 or 2 year treasuries or CDs or whatever for very low risk money, you may have missed the boat, because a lot of institutions or other buyers have already gone into that space, bid the price up on those bonds, and push the yields down. So you, to your point, you can kind of miss that if you're playing that game too closely. And there's a big difference between, I think, folks that want to keep money in a daily liquid money market versus locking it up for 2, 3, 5 years, and holding a specific rate over that time. For investment portfolios, for long run investment portfolios, we typically have money, truly invested and not just sitting in a daily liquid money fund. But
100%.
it's been a big uptick for people that do want, and everybody needs to have some safe money, right? And that's money market or treasuries or CDs. And like Kyle mentioned earlier, it's nice to be able to tell them they're actually getting paid to hold that money now. Those are suddenly they're large payments that come into to folks' accounts on a monthly basis for money market distributions.
And I think we say this on every roundtable, but just to follow on to what Jason was saying, for every client that has a question that starts, why don't I just wait until and then whatever after that, markets are a leading indicator. You just can't wait until it happens and then think that you're right at the forefront. You're already well behind. So why don't I just wait until rates top out, because things have already adjusted before then. So it's a difficult concept to understand, but markets have already priced in a lot of the information that they expect to happen in the future, and the only thing that really changes that is new information that changes those expectations.
Yeah. Well, and that goes back to what Jason said too, as far as everybody's situation is different. And so anything we're saying here is we're not telling you to go out and lock all your money up for a long period of time. It's reach out to us, talk to us, have a conversation, figure out what makes sense for different pockets or, pools of your money, and come up with the right solution for you and your situation, because everyone's unique.
Well, do you remember a couple of sessions ago we were talking about I bonds and the rush to buy those at 9.62. That was the big number.
Yep.
I just looked 6.89. So for new buyers there, the market's already paying you quite a bit less. That's a pretty big haircut from 962 to 689. So, and that'll continue. I would expect that to come down dramatically the next 6-month period that pops up.
Yep.
For sure.
It just won't be as attractive. So we talked about inflation enough.
Yeah. I think we killed. Although, I mean, listen, it's the one thing everyone wants to talk about, and it's the main thing driving the market.
Yep.
But so new year, we've been off to a good start. Little more good news. Why don't you guys talk a little bit about new defined contribution plan limits and how that might affect people?
I think we got a chart for it to kind of show updates here. With the new limits, the 401k limits and such, what another driver of inflation that has occurred is that with the, as inflation drives up the price of eggs and everything else, it's also going to be driving up the contribution amounts that we're allowed to put into our retirement accounts. And so increases have gone up not only on IRAs, 401ks, Roth IRAs, and the like. Let me look over here. So, for example, on last year for your 401ks, the maximum limit was $20,500. It's now gone up about 10%, up to $22,500. It's gone up $2,000. IRAs have gone from $6,000 to $6,500. And so we've seen those bump up a little bit in all cases. And so for any of you that still fund a 401k, fund IRAs, fund Roth IRAs, I urge you just to take a look, log into your account. Most of you probably do it once a year. Check with your HR, log into the website, whatever you've got access to. Go verify if you are able to max out your 401k, that you are still taking advantage of that. And for those that aren't maxing out a 401k, I strongly, strongly urge you to recognize and verify if your employer offers you a match of any kind. I hate to say this on a podcast. Figure out a way to get the money and put it in, because any type of match, it's 100% free bonus money. Even if your investments just went into cash and money market fund, you still have an annualized 100% return on your investment. So figure out a way to at least max the match. Last point, kind of on the 401ks, I would mention, most people are not aware that if you have a 401k through an employer, in almost every case I've seen, they have a traditional 401k and they also have a Roth 401k. Every person's situation is different based upon taxes and age and everything else like that. But for many opportunities, I think that especially for younger folks, you ought to go into the, speak with us and verify, but then go into your HR, go into your website and look for the little radio button. It's going to be right where you can change your contributions and you can switch from regular 401k to Roth 401k. We could spend a whole podcast talking about the benefits of that. But in essence, I kind of look at it, I had a client once upon a time tell me, who's a farmer, I'd rather pay taxes on the seed than on the harvest. And so the thought process there is pay the tax on the money while it's small, going in your 401k as a contribution, and then leave it in there for 10, 20, 30, 40 years. And then when it comes out, it's all going to be tax-free. So
one other thing I wanted to mention there too, Jason, was you mentioned contribution limits, and that's just the contribution limits for the plans, but there's also the catch-up provisions that are eligible for people that are over 50. So we saw those go up too. What was the final number on the new for the catch-up? Was it 7,500?
It's 7,500 in it.
So 30,000 total, correct?
Yep. In addition to the
30,000 total for those of you that are over 50, and then obviously we got a bump in the IRA levels that we talked about too on the contributions, but they also have the catch-up provision as well. So,
right, like Jason mentioned, so we folks want to put money into a Roth IRA all the time. We hear about Roth IRAs, but the plan limits or the limit on a Roth 401k Roth IRA is $6,500 for somebody under 50, $7,500 for somebody over 50. Mm-hmm. Well, if you have an employer plan that does allow, and like Jason mentioned, most of them do, for Roth contributions into that plan, the limit is $30,000. You can put $30,000 into that after tax, that then grows, that particular part grows tax free. So $30,000 a year is a really big number for somebody over 50 that, like Jason mentioned, if their strategy is pay the tax now rather than pay it later, that's a much higher limit than $7,500 in that case.
And for anybody
Well, the phase out limits too, right?
Yeah,
So Roth
phase
contributions, depending on your income level, you may not even be eligible to make contributions to a Roth IRA, but those income limits don't apply to retirement plans as far as 401ks.
Yeah, the only other thing to know on the Roth 401k is that's only for your own personal contributions. So if you do get a match, that's going to go on the company side because the company gets a deduction from it. So you can contribute, like say you're 50 or over, you can contribute $30,000 to a Roth 401k. But let's say you get a company match, well then that will go in the pre-tax bucket. So you have two different buckets there. But it's still money.
There is a new wrinkle. Maybe we should cover this just in something very specific in a different breakout. But with some legislation that was just passed in December, that for our business owner clients really need to pay attention to some of the plan changes that just came down, because there's talk about allowing for a Roth contribution, which has never been part of the equation since Roth came out in 1998 or 99
right.
or whatever it was. So that's going to be something super interesting too.
Yeah, we'll have to follow up on that. So questions from clients is one of the things we always like to do in the roundtable. Top questions we're getting. I know one we just had yesterday that I think is a good one to address, because people don't always understand the relationship and how different dynamics work. So had a client ask why their banker doesn't call them about higher rates. We've been talking about rates, right? We've been talking about inflation and how money market rates have moved up and treasury rates have moved up. Well, I looked on Business Insider and found that, again, this is according to the FDIC, which is insurance of banks. The average savings account is right at 33 basis points right now, so 0.33% on an annual basis. And the CD, obviously, depending on the term of the CD, is between 15 basis points, so 0.15%, and 1.28%. Now, we just had the conversation, 5-10 minutes ago about how money market's paying 4.5%. And so we get a question from clients of why does my banker let me know that I can, earn higher rates in my depositor account than just letting it sit there in cash? Well, I'll start with this, but you guys can kick on. Basically, you're looking at two different relationships. So the bank relationship is what we call a depositor relationship. You've deposited your money in the bank. So you've given your money to the bank then owns your money, and they turn around and loan that money back out. And that's how they make money. That's the spread. The FDIC insurance, people always ask, do you guys have FDIC insurance? We're a custodial relationship. So the FDIC insurance is for a depositor relationship. If you're depositing money in the bank, you've effectively given your money to the bank. If the bank goes under, you don't have any money. Well, the FDIC insurance is there to guarantee you a certain amount of money. Should the bank go under, the federal government guarantees that you'll at least get the $250,000 back. And that's why those limits exist and why you shouldn't really have more than that in any individual account, because you're over the limit. And if the bank goes under, then that's all you're insured for. Our relationship here, what we do is a custodial relationship. So we happen to use Schwab a lot for our custodian, but we can use Fidelity and a number of others, where they just actually hold certificates. They hold the assets. They don't turn around and loan your assets back out. It's strictly a holding, like I said, a holding relationship. So while the banker has really a conflict of interest, because the bank itself wants to pay you as little interest as possible and turn around and loan that money back out as high a rate as possible because they're earning the spread. That's not how we operate. Obviously, all of our clients know that we're fee for service and we charge a fee to manage money. If you make more money, that's actually a better thing for us. So we're looking for the best opportunity to get you into a higher earning money market or a CD or a Treasury, wherever that makes sense, because there is no conflict of interest for us. So it's a completely different relationship. And I'll let you guys kind of, follow on that a little bit. But the difference I always say, when we're making it very clear to clients is, at the bank, you're invested in the bank. With us, you're invested at Charles Schwab. You're invested at the custodian, but you're not necessarily invested in Charles Schwab. If Charles Schwab goes under, somebody else, another custodian, picks up that account, and exactly what's in that account is still in that account with somebody else.
Yeah, very good explanation. I don't really have anything to comment on that. It was good. I kind of referenced Schwab as almost like it's like a storage center.
Yeah.
They, we pay them to hold it. That's how they get their revenue. They're not, go find me a Schwab car loan or a Schwab home loan. That's exactly right. They're not loaning the money out. And so that's a big fear people have had, especially when banks have been in troubles before and custodians, they worry, well, what if they go under? What if? And that's exactly the point, like you mentioned. They don't have your money out. And so if they go under, someone else just keeps carrying the load out of the storage unit.
Well, and it explains too, like you said, you had the conversation with the client, working with a local nonprofit, they have some money that's sitting aside on some reserves, and we're reaching out to their banking relationships. And so not even what they're giving you in your savings or your CDs, but when you're actually proactively reaching out and checking for rates and what's out there, they're still significantly under what we're seeing in the markets and we have for our clients here on both the money market as well as the CD rates. I think they were quoted 1% for a 12-month CD. So there's definitely other options out there. And that's kind of the importance of us having this conversation with clients is, listen, our role has always been all your assets and giving you that guidance and helping you manage that and plan for the future. And, it's been a while since we could actually target or focus on guidance towards that short-term money, because there really wasn't any other option out there other than just what you were doing. So nice being compensated now for the interest rates they're out there. And it makes sense to take advantage of it. And I know one of the things we talk about too is clients say, well, okay, so what? Do I have to close my checking account, Adam? Do I have to close my savings account at the bank? I like my banking relationship. I have all my bill pays tied to it. Well, yeah, you're right. You do. And no, we don't want you to. We don't want to balance checking accounts, and we don't want to manage your checking accounts. And so one of the features that are nice is that we have the ability to essentially link through ACH between us and your existing checking or savings account. And so the benefit there is that money can be transferred electronically both ways. Similar to me, if I log into my banking app and I move it from my checking account to my savings account, it's the same process there. Essentially, it's just changing custodians there from the bank to Schwab in this case. So money can move over, can sit in the money market we talked about, which was fully liquid. And then essentially pass that back to the bank when you need to continue using your checking account there or, your bill pay.
We're all saying something similar, but what we're the way I sort of sketch it out is we're not meant to replace your banking relationship.
Correct.
But you in terms of investments, having money in a savings account as a large portion or a lot of money in a savings account may not be what's best for you as a client. There are probably better ways to keep that money working still at fairly low risk. And even in things that are FDIC insured, we have a lot of access to a lot of different ways that money can be invested, and usually much more beneficial than leaving it in something liquid and paying next to nothing. So
this is the first time in 15 years. Again, clients have had it didn't matter where you kept your cash. It didn't matter what bank it was, online or otherwise. Yep. Everyone just paid zero. So this is the first time I remind clients it makes sense to shop your cash. And I don't know if I thought of it, if I read it somewhere, but I thought it was kind of funny that if your cash is being held in a building or a bank that has buildings, you're probably not getting the best rate because their overhead is greater. And so whether it be, with us or a Capital One or a Amex or somewhere it makes sense to at least do some homework and shop the rate.
Yeah, I'm glad you said that, because I was thinking about our clients that have been with us forever and probably starting to get angry that we haven't been putting them in this 4.5% money market. So as I mentioned, the money market was 7 basis points in January of 22. So things change. Yep. And like Jason was just saying, this didn't always exist. And when rates go to zero, there's not much juice. But right now, it's a completely different environment. So if you're holding money at the bank in your savings account or buying CDs at 1%, it's at least worth exploring. There's probably a better option that's available, and again, no conflict of interest for us. But if we were bankers, I'd be doing the same thing. I mean, you're trying to make the spread. I mean, I think they should probably be reaching out to people and letting them know that maybe there's something a little bit better. But again, all of their income is derived from spreads. And we just don't work like that.
And just expectations wise, it's hard for them to reach out to people and offer them higher rates because they're just offering them back their profits.
Correct.
And that's if you just think about human nature or business sense, it's hard to just give all your profits back away to your customers in their case. And again, to your point, that's why we're different, because we're not taking a part of their profits. We're a totally different interface and relationship. So anyway.
Other questions? I think we've hammered the interest and inflation because it all kind of goes back and forth between, what we've seen the last year and a half with raising rates and inflation, and now how it benefits our safe money. But other things that have come up, I know personally, we talked about a lot last year that, the things that were driving the market was, we said interest rate, inflation, we had the Russia, Ukraine, and then we had the other R, which was recession. So without getting political and defining what a recession is, because obviously that's a moving definition over the last year and a half. But, we had the 2 negative quarters of GDP growth last year that, historically has triggered, or, the official recession, if you will. But we have not entered into one officially right now as of, February. But most analysts and people that we follow and look to are kind of forecasting a slowing of this economy and heading into a recession at some point in 2023. And I say that because I bring that up in client meetings, and I know you guys do as well. And the first question is, well, what do we do? Do we go to cash? You just talked about how cash and interest rates are right. I mean, do we get out of everything and avoid it? And, let me pull up a chart here real quick on, stock market kind of performance, during recessions. And the reason why I point this out is obviously history is history, and, we can't predict the future, but we've talked about it with interest rates, with inflation. Markets are leading indicators, right? So the data that we're talking about and the points that we're looking at, the market's already priced in and aware. So historically speaking, most of the downside that we experience from a market performance happens prior to or early stages into the recession. And so regardless of whether or not we would go into recession today or in 6 months, most of us believe that the downside that we experience in that recession has already happened. And in the case of last year, we had a pretty down year. So I think most of us feel that would be kind of where that downside was experienced, and that during the recession and coming out of the recession, it's not as painful, and it can actually be, rather beneficial for the market. And that's, again, because it's a leading indicator, right? So the economy shrinks, the economy slows down, and eventually, once that kind of gets behind us, it starts opening back up, and consumer spending picks up, and the growth picks up, and that's what benefits the stock market. So it kind of, the underperformance or the downside precedes the actual recession historically, and then during and coming out of them, we actually see some potential, growth and upside in these markets. And so, though we do feel that the recession is likely at some point this year, it's not necessarily a concern for panic or running to cash. And things we kind of look to is, more of the depth and the duration of the recession, right? Is it going to be -4.5%, -5% GDP growth for 2 years, 3 years, or is it going to be more of that -0.1 or -1% for a couple quarters to a year? So those are the things that we're looking at that can maybe have more of an impact on the actual market. It is more the depth and the duration of the recession rather than whether or not we go into a recession.
If and when we do go through a recession this year, it'll be the most telegraphed recession in U.S. history.
Correct.
We have been waiting for a recession for a year, and everybody is on pins and needles wondering exactly what Kyle just described: length, depth, shallow, not, whatever. And so a way I just described it with the client, I thought this kind of made sense, is we've all seen that, and I may have even mentioned this on the last podcast. We've all seen that hurricane that when they run it on the news, the hurricane that is inevitably heading to Florida, and it's out in the Gulf. Oh my God, it's a Category 5. It's going to hit Florida in 5 days or something like that. Well, every single resident in Florida at that point in time has made a decision on what they're going to do. Are they going to stay? Are they going to board up? Are they going to leave, etc.? So while it's floating around in the Gulf, they're reacting and they're making their decisions. So by the time it actually hits land, no one at that point is like, I wonder what I should do. They've already decided one way or the other. And so this is a very similar situation. So we're watching. Last year, we're pricing in this Category 5 hurricane that's going to come through. Everyone's made a decision. The clients that want to ride this out and stick through their investment portfolios, that they're going to do it through thick or thin. Those that wanted to get more conservative most likely already have. And so by the time this recession actually comes, it'll be like, oh, all right, well, it wasn't Category 5, it potentially is Category 2. I'm going to go back to work. And then life will go on, and that's kind of what I'm anticipating this year.
That's a pretty good analogy, though, because there will be destruction. That's still the design of raising interest rates. They're trying to push down spending and investments, and that's their main tool, main lever is short-term interest rates. So it's the only way you can get to the other side is by having some impact. But what we're always trying to work to do is minimize the impact, and most importantly, be positioned for what's coming. And I think that's, for the four of us, that's what we're really focused on, is making sure that we're ready for, whatever the next step is.
Well, and continuing on that analogy, that ties back into, talking about boarding up or taking precautions or plans for a hurricane, right? Well, that's the whole point of financial planning, right? Is our financial plans don't assume this market's going to go straight up every single quarter, every single month for the rest of your life, right? We bake in assumptions that, just like history, we're going to have recessions, we're going to have corrections, we're going to have 20% years that are down, 20 years that are up. And so that's part of the planning is having a plan, knowing that these events will happen, not knowing if it's today, tomorrow, and 5 years, but then also making sure that as we're preparing, going through and coming out of it, there's activity and actions that need to take place on an account level, depending on each person's situation. And I know from sitting in the office with all you guys that everybody here is very proactive. We don't just sit back and do nothing. It's reactionary when we need to, but also not overreacting, and allowing the plan to take its course and run its course, and keeping people informed and up to date.
Yeah, and like we've been telling clients, recessions are part of market cycles.
Yep.
Just like weather patterns. I mean, you're gonna have these situations. The leading indicator thing we've talked about now twice. We'll talk about it again, I'm sure, the next roundtable, and probably everyone until we're out of this business, because it's a difficult concept. Said these things got priced in as soon as markets could see that we might possibly be in for inflation and a recession. All this stuff gets priced in, and that's basically a lot of 22. And now we're waiting to see if it's going to be worse than is already priced in. And, hopefully not. It doesn't look like it at this point. And so, that's kind of where we come to. Last part of this is predictions for 23. We always like to give a little bit of what may be, what we may expect. And I know Kyle and I have talked offline a little bit about, the old, he calls it 2 steps forward, 1 step back. I call it, bumping around, where, 1 month looks great, and the next month everybody changes their mind a little bit. And the next month, oh no, we're, inflation's coming down and the Fed's not going to raise rates as much as we thought. And then the next month, probabilities go from 3% to 71%. And so you see a market pullback. So, but that's mine for 23. I think we're going to see a lot of up and down, where maybe you end up, 5-6 months down the road and you don't feel very far ahead from where we started. But again, it's very difficult to time the market, because, as somebody once said, when's the market bottom? You wait until it happened, and then you say, oh, that's when it was about 6 months ago. That's the best way to determine.
Well, I like you said, Adam, we talked about it, so I'm kind of in the same camp, and we've been looking that way for this year, is that it's that 2 steps forward, 1 step back. Everything's going to be reactionary to news and data, and maybe not even data, just words. What is Jerome Powell going to say next? Is it, is he going to be dovish? Is it hawkish? Is it going to be, aggressive rates, or slow down on the rate hikes? And is inflation going to go from 6 to 3 or 6 to 5? So I think it's going to be reactionary, and that's what we've seen the last couple of weeks here towards the end of February. So we had a great start to the year, and now all of a sudden we had one little misprint in the inflation number, and it's like, well, maybe they will keep raising rates longer, and so we better take some profits. And so the market is very volatile in the short term, and that's why I think it's important for us to keep that long-term mindset, and yet still pay attention to the data and the noise in the market on a day-to-day. But that's my theory too, that it's going to be one of those 2 steps forward, 1 step back kind of year. What will determine whether that's a positive or a negative at the end is a lot, out there still, as far as what that inflation number looks like. I think if that inflation comes down below 4-5%, then I think we can have a positive year. But that's kind of where we're at right now, is that 2 step forward.
How about the fact that most time people probably couldn't even tell you who the Fed chair is, and now they're like reading his facial expressions.
Did he say it this way?
Did he say it angrily, or was it like softly? How did it really come out? So
yeah, Greenspan, irrational exuberance. That was one of the most popular phrases for a while.
Irrational exuberance.
Yeah. Well, volatility is, the VIX, which measures market volatility, is in the low 20s again. I mean, I don't hear many people talking about that, but it is way down from where it was, mid to late last year, and in a very sort of long-term normal range. That may be the upper part of, calm markets, but it's definitely calmed quite a bit in the last 6 or 8 months. So, they tend to peak when things get really crazy. But yeah, I mean, VIX is in the 20 range right now. And so that just indicates that volatility is down, generally speaking, from where it was at crisis times. But, that's going to determine some of what happens with the equity markets too.
As far as if we're doing kind of general fund predictions or whatever,
S&P price target.
Here's kind of what I was looking at and stories I tell when it comes to stocks and bonds. And now, I had a brand new client, educated, smart person, but never been involved in this stuff. And recently retired, 401k, just kind of put away. And then we're starting the relation. They said, okay, so now that we're getting this thing going, so your job, you're going to call me before the market goes down, right? And then we can get out. I'm like, I don't know if you know what I do, but that's not it. I might have a crystal ball on my desk, but it doesn't work. And so I said,
a little foggy there, huh?
And very serious. This person said, well, why not? I thought that's what you folks did, is that you were able to, because you do this every day, you have insight as to what the market direction is going to be in a very short-term matter. And I said, the complication predicting something like that, even if we had all the information, I mean, just to get market direction, you would need to know off the top of my head what Putin's going to do, President Xi's going to do, Biden's going to do. You would need to know what oil is going to be. You would need to know what the weather is going to be. You would need to know what inflation is going to be, interest rates going to be, and 1,000 other things I'm not thinking of to even get close to what the market might do, because there's thousands of factors that formulate into that.
Well, an emotion, right? Aside from just actual events and things,
aside from data,
predict general human emotion 6 months from now. And so obviously that's not something we can predict in any term, short or long. And so then started to look then into, just market history. We've never gone through anything like this before. I'm getting tired of these 100-year events, whether it's, COVID or bond markets or whatever, but it seems like we get a 100-year event right after a 100-year event. Now here in California, we're going through a 100-year event of rain, but it's 100-year event after 100-year event. But I tie this back into bonds. And so a common conversation I've had with clients around the bond market, this thought process of bonds were kind of our safe money, our safe asset, and the rug got pulled last year. And so clients wondering, okay, interest rates have been high and higher before. Why didn't bonds drop like that before? Did the quality or the confidence in bonds change? And I described to them and I explained, no, absolutely not. It really comes down to math. And I'm sure you guys can jump in and opine on this a little bit better. But basically what I explained to the client is like, okay, let's go back 40 years ago when interest rates hit their all-time high into the high teens. And prior to that, in the 70s, I'm not sure exactly what they were, but let's say they're like 7, 8, 9%, something like that. So I said, now think about in that point in time, what did interest rates do? They doubled. They went from like, let's say 8 to 16, 9 to 18, something like that. Now what we just went through prior to having the worst year in bonds ever, so let's just go back, since 1776. But what also happened just prior to that, interest rates were at the lowest they had ever been. So then when we saw a 10-year Treasury go from 1.5 to 4.5, that wasn't a double, that was a triple. So it really just came down to math. It was a 3x move instead of a 2x move back in the 80s. And so that kind of violence in the jump in rates is what caused bonds to go down. But now looking at it, now coming back to it, if I could buy a sound investment that just had its worst year ever, then I've got confidence going forward. And when I look back in bonds previously, and I went back, solid 75 years, we've never had two bad bond years back to back. Usually cooler heads prevail. The interest rates are higher on the bonds and money comes in. So I think bonds might stabilize a little bit this year. I don't think interest rates are going to be as violent. So that's a prediction there, is I really think bonds will come down and kind of return to the safe asset, and we're getting interest on it. The other thing, now this is a dart throw, but
watch out, Tesla.
Here we go.
I kind of back out the Great Depression in this, because 1929, before the Securities Act and really laws came in, I don't like to compare what happened in 1929 to say, well, what if again, because it's really kind of a different place in time. But barring 1929 to 1931, take that out, and since then, the stock market has never been down 20 or more % and then not been up the next year. That hasn't happened. So every single time the market's been down 20% or more and clocked that in for the year, so far, each year thereafter was in the green. So I'm hoping the VIX stays low, volatility stays low. I'm not optimistic there. I think we'll have a lot of volatility this year, but it wouldn't surprise me if both markets, bonds and stocks, are up at the end of the year. Not a lot, but they could be both green.
And tying back to that, as far as we've all kind of talked about the 2 steps forward, 1 step back, what our predictions are for the market. We've had a lot of conversation on risk or volatility. I think one of the things we always, at least I had conversation with, I'm sure we did around the office and with clients too, even in the beginning and last year when things were down, is when things are down, it's not time to rebalance your portfolio or change your risk or get out of the market. It's when things are doing better. And so one of the tools that we have here, if you go to strongvalley.com/risk, it's our risk software. I know we've talked about it in a previous call, but aside or along with, in partnership with your financial plan, it allows us to really determine where you are as an individual on your risk tolerance. It's not like one of those things where we throw out there, are you moderate? Are you conservative? Are you aggressive? Or moderate growth and income? And all the terms that get thrown around in the industry. It actually puts a feel from a dollar standpoint on your answers and bases off of your level of comfort in a market and with real dollars versus just, in our world, we talk percentages a lot. But in clients' world, it's dollars that have that impact, right? So if you had $1 million and you're down 2%, feels a lot worse than when you had $10,000 and you're down 2%. The real dollars move. And so it allows us to put a dollar amount and stress test during different scenarios and where you're comfortable or not comfortable, and allows us to kind of realign or structure portfolios accordingly, assuming it still matches up with your financial plan. So just one of those other, software that we have out there and tools that we use with clients and in meetings to help kind of feel where that comfort level is, knowing that, markets go up, markets go down. We can't guarantee when the next one will be, but making sure that we can show that impact and what it might do on your portfolio. So
it's good. It's a good point. So we'll kind of wrap it up with that. I mean, listen, we love doing these. We'll be back in May and do it again. Maybe we love them a little more when the market's up, but maybe a little more valuable when the market's down. I don't know. Probably the biggest thing though is reach out to us individually. We're happy to talk to people about any individual questions you have. And as you can see, we use some of these questions without names, obviously, on the roundtable. So if there's one person, we always say, if there's one person that has a question, there's probably 10 other people that have the same question. They're just not asking it. So we try to try to answer as much as we can and talk about, the markets and the economy and what's driving. And if there's anything you want to see, we're happy to talk about that as well. You can see some of the things are a little bit off the cuff, like, the difference between a bank and a custodian. That's kind of what we went over a little bit today. And we're happy to get into more depth with that, if needed or on an individual basis. You can subscribe to our channel to stay connected, so when the roundtables are coming up. It's pretty transparent. It's middle of every quarter. So February, May, what are we at? August and October or November
ish.
So ish. So that's when the roundtables will happen. And in between that, we do the monthly market matters, which if you want a shorter, just sort of recap on the previous month and what we're looking forward to that month, those are typically, 15 minutes or so. But this is when we kind of all get together and throw everything out, so to speak. Again, appreciate everybody joining us. We'll be back next month with a shorter one. And like I said, in May, we'll be back with another roundtable and looking forward to a good 2023. Thanks, everybody.
Thank you all.
Yep. Thank you.
See you all. Have a good one.